Credit runs everything, ladies and gentlemen. Equities are the tail of the dog. The dog is credit. Equities get flung around like a rag doll.
You said that, that it wags the dog, right? So everything happens in the bond market first, and then kind of it's the equities later.
There used to be a time when $10 billion was a lot of money. It doesn't seem like it is anymore, right?
It seems like, the central banks, the Fed, the central banks, they kind of have tools at their disposal: monetary policy, fiscal policy. So, basically inflation, interest rates and debt creation. And it seems like we're seeing their tool chest empty out, in a sense where interest rates are basically at zero.
Yes.
And debt is at levels that can't be seen.
You own the bonds are losing value. You can try and sell the bonds, or you can just say, hey, I still think these bonds are worth 100 cents on the dollar. So why don't I just hedge that up against equity?
The financial markets are bubbling over. Turmoil is on the verge of happening at any point that you look at. Now, one of the things that most people focus on is what's happening in the stock markets and what is going to happen. Will stocks crash or won't they? Well, there's another way to look at this. What the real professional investors look at are the bonds. The debt markets, the credit markets are really what's leading this whole thing. Some people might say that the stocks are just the tail of the dog, where the bonds, the credit markets are the actual dog themselves. So today I am sitting down with Greg Foss. He's been a 30-year veteran trading credit, trading bonds, and he has some amazing insights into what's going on in the market. He's going to break down what's happening with the bond yields, how the Fed is looking at that, what they're going to have to do to move and control those bond yields. He's also going to talk about the total amount of bond and credit debt that's out there in the world today. And we're going to talk about where that debt is going to start transition into. We're going to talk about some other assets, and he's even going to give us his forecast of where he thinks these assets are going to go in the near and the long term. It's an amazing conversation with Greg, one that I really was excited to have. It was a great conversation, did not disappoint, and you were going to like it. So let's go ahead and just jump right into the interview with Greg. Hey everyone, welcome to another episode of the Market Disruptor Show. And today I am joined by Greg Foss. He's an experienced credit trader in the bond markets, 30 years trading in the credit market. He's also with the company Validus Power that's kind of changing the game in Bitcoin mining, which is pretty cool. And so anyway, Greg, thanks so much for joining me today.
What a pleasure. Thank you for having me.
So I've been keeping up with you. As I kind of said earlier, I mean, you kind of stormed the Bitcoin scene. You have a lot of really good takes, and I know that comes from your deep experience. So for those that are just catching up to you, why don't you give us a little bit of that experience and kind of like what brought you here?
Sure. Well, thanks for having me again. And I won't bore too many people, but I've been doing this for 30 years. Doing what you would ask, I say, I've been managing credit risk for 30 years. And I'm a Canadian, live near Toronto, but I grew up in Montreal, went to engineering. And that's important because engineering and Bitcoin are very, very linked in my opinion. And we'll get into that. But essentially, Bitcoin is digital energy. So park that thought for a second. I was an engineer at McGill, went down and decided to do an MBA at Cornell in the United States. Ivy League education, very proud of that, but came back and worked for Canada's largest financial institution in the bank, a bank called the Royal Bank of Canada. And I started in 1988. And it was an eye-opening experience because Royal Bank of Canada was insolvent. Royal Bank of Canada was no different than Chase Manhattan, Manufacturers Hanover, all the big money center banks in New York City. Everyone had far too much loan exposure to lesser developed countries, LDC. Lesser developed countries mostly focus on South America, so Brazil and Mexico. And what does insolvent mean? Just for your viewers, a refresher, it means that if you were to mark to market the value of those loans because they had defaulted, you would have to write off an amount that exceeded the book value of equity of the Royal Bank of Canada. Yeah, this is pretty eye-opening, man. This is Canada's largest financial institution is insolvent. Another word is bankrupt. There's a slight difference, but it doesn't matter. And hence Treasury Secretary Nicholas Brady from the United States designed a brilliant solution called the Brady Plan, which changed 5-year loans, which were trading at 25 cents on the dollar. Not a lot of trading was taking place, but that was essentially the market quote, 25 cents on the dollar. He changed out 5-year obligation at 100 cents on the dollar into a 30-year obligation at a 30-year obligation, trading at 25 cents on the dollar, valued, but the banks did not have to write it down because it was backed by.
Hey guys, let me just interrupt this interview real quick just to plug the show sponsor, and that is BlockFi. Now, BlockFi is doing amazing things in the Bitcoin finance space. As a matter of fact, they've cracked some really big news by bringing on the ex-CFTC chair, Chris Giancarlo, and they are one of the most transparent, most heavily regulated companies inside the United States, which gives me a lot of trust into what their services are. Now, I've recently did a video talking about how to retire off of Bitcoin, and you can do that by leveraging debt and interest against Bitcoin. And BlockFi is the number one company in the United States, or maybe in the world, to go to and use. They are leading the charge. They're paying interest on your Bitcoin if you park it with them, or you can borrow against it. Now, as I broke down in that video, you can borrow against your Bitcoin. And when you take debt against it, it's not taxable. It's not a taxable event. You can use that debt for anything that you want, including to live off of, to leverage up and buy more, or roll it into another asset. You can do something like I've done recently, like sell some real estate, put that money into Bitcoin. Now, as that Bitcoin price has risen, I'm able to borrow against it and go back and buy the same real estate or something similar. And I still own the Bitcoin, and I also own the new asset as well. Lots of ways you can do this. And BlockFi is the company that I recommend. Down in the description, I have a link that you can click on. If you choose to use that link, you can earn up to $250 in Bitcoin just for using that link. So check out BlockFi now.
Zero coupon US Treasury debt. Wow. What an accounting gimmickry, right? And that being said, it was my first experience too. How is this possible? You know, again, you go all through business school and you're like, you think you know something until you get into the real world. And the reality is banks are frequently insolvent. I'll make that statement on a mark-to-market basis. And they are 25 times levered to their capital position. Not getting too granular, but why are banks therefore have the confidence of the public? Quite simple. They are too big to fail generally, and therefore backed by their governments. If they're backed by the governments, how does the government maintain this? Very simple, printing money. So back in 1988, I was looking for a solution to the fiat Ponzi. I'll call it that because that's what I believe it is. It's a Ponzi because the backstop has always been the ability to print money. And fast forward, so I went into high yield credit trading after the Royal Bank. I went into high yield credit trading. I was Canada's first high yield credit trader that took positions in fallen angel and distressed credits in Canada. Now, New York had a very vibrant high yield market, but Canada was about 20 years behind. So I helped develop that market. I lived through the long-term credit debacle. That was in 1998. I lived through the great financial crisis, working at a hedge fund that, honest to God, I was wondering where the world would end any day in 2009. And through that, I still questioned the stability. Well, always questioned the stability, but always understood it. So the ability to print money. And then in 2016, I found Bitcoin, and it was the most beautiful technology that I've ever seen. From an engineering perspective, Mark, this is important because I saw the Bitcoin blockchain in action, and I'm like, wow, I'd heard of Bitcoin, but I didn't realize it was this beautiful. And then I said, and what? There's 21 million of them only? And what? You know, and I just started going down the rabbit hole, and I said, this thing is phenomenal. Mm-hmm. And for 5 years, I've been studying Bitcoin essentially. So yeah, I did sort of storm onto the scene only because I only discovered Twitter and what a valuable resource Twitter is. Because I'm 57, Mark. And when you're 57, you know, a lot of things aren't as natural as when you're 27, meaning Twitter and an iPhone and the such. So yeah, I did. How about this? I didn't storm onto the scene. I stumbled onto the scene. And then I just said this, okay, I got to help people understand the relationship between credit, where I spent 30 years, and the necessity to protect yourself against the regular disruptions in credit markets. Credit runs everything, ladies and gentlemen. Equities are the tail of the dog. The dog is credit. Mm-hmm. Equities get flung around like a rag doll because the equity markets are tiny compared to the credit markets. And credit regularly gurgles. And when credit gurgles, equities get destroyed. So
Yeah.
that's my little pitch.
Yeah, well, that's great. Well, so for everybody listening, I mean, there's so much that we're going to unpack right here. Now, if you're listening, I routinely dig into what's happening with central banks, the banking industry, and whatnot, because we obviously have to understand how we can protect our
Sure.
money. I love what you said there, Greg, about really. I'm trying to get people to start focusing on really like its purchasing power and stop looking at like unit of account and denominators and whatnot. So I want to dig into that first, and then we'll kind of dig into solutions, the life rafts that we have.
Sure.
But you said that that it wags the dog, right? So everything happens in the bond market first, and like then kind of it's the equities later. And I know some of the smartest, the best investors in the world really focus on the bond market, and we can see that even just in the March crash of last year, where the Feds really intervened in the bond markets.
Yes.
So maybe you can kind of explain that, maybe unpack that a little bit. Like, why is it that the bond market wags the tail, or the equities are the tail of that dog, I guess?
Okay, so pretty simply, first of all, they're much bigger. Secondly, the whole world is levered, okay? And given that leverage essentially is debt in various forms, counterparty risk, et cetera, a frequent occurrence is when leverage gets taken out of the system, whether hedge funds, the latest Archegos example, where CSFB, there's rumors, that CSFB was on the brink. I'm not going to make that rumor. I don't want hate mail. I'll just tell you that, they lost $10 billion. There used to be a time when $10 billion was a lot of money. It doesn't seem like it is anymore, right? But let me just say that there's a tremendous number of critical financial institutions and stability. And if one of them goes down, and this is what we saw with Lehman Brothers in 2006, it started in 2006, 2007, finished in 2009. One domino can have tremendous repercussions. So, but let's start
because of the leverage
and the counterparty risk, right? Let's just say you've hedged yourself up, but your counterparty is Lehman, and you're Bear Stearns, and you have protection bought from Lehman. Or your hedge fund that has a counterparty risk with Lehman, and all of a sudden Lehman is not able to make good on their contracts. Well, look, that's a huge black hole in the hedge fund. It has exposure to other counterparties, et cetera. So, but let's start with the reality. Okay, so credit has first claim if in the capital structure of a company ABC, credit. The bonds have first claim, prior claim. So that means if the bonds aren't worth 100 cents on the dollar, the equity's worth zero. Every single equity analyst out there needs to start their analysis with an understanding of what the credit rating of that company is. It's amazing.
I heard you say that point before, and it's such a great point. Why don't you just explain that? So if the bonds aren't worth it, then the equity is worth zero. So how could the equity is worth?
Listen, I've worked on trading floors where the equity analysts are running over to me all the time, like, what's happening with my credit, with my company ABC? I'm like, dude, the bonds are getting destroyed. So there's hedge funds out there that own the bonds that are shorting the equity as protection against the bonds they own. Think about that, right? That's a natural hedge. You own the bonds are losing value. You can try and sell the bonds, or you can just say, hey, I still think these bonds are worth 100 cents on the dollar. So why don't I just hedge that up against equity? And there's a tremendous capital structure arbitrage market that goes on in the markets. It's fun. It's dangerous because you can get squashed, but it is Finance 101. The bonds are prior claim in the capital structure. So any equity owner better understand where the bonds are trading. This is why things like AMC and GameStop, which had high yield bonds outstanding, and therefore guys that were short the equity against the bonds, they got railroaded because all of a sudden they do a short squeeze, right? And it's like they're putting on a good risk adjusted trade, but shorts, it's dangerous to be short. As you know, the bonds don't rally, but the equity goes through the roof. It makes no sense on an enterprise value basis, but that's the way the world can work. Okay. So
let me see if we understand this. I just want to unpack for the listeners here. So basically, if you're not really caught up with what he's saying, I mean, bonds are debt. So a company's taking on debt, and he talked about earlier kind of insolvency. So the company's taking on debt, that's their bonds, and then they have their equity price. Correct. The problem is that as an equity owner, when you own stocks, you own equity, you own the company, but the debt is senior to
Prior
them.
claim,
So,
correct.
what he's saying is that if their bonds aren't worth anything, then they're bankrupt, which means
Let's
how
be
can the
careful.
stock be
And
worth?
bonds trade, well, there you go. But let's just unpack that a little bit more. Bonds trade for a price as well. Generally, that
Right.
price at issue is 100 cents on the dollar. Let's just assume the general level of interest rates don't change, and it's only the credit quality of the company that comes into play. If the credit quality improves and the coupon that the company was paying started as an 8% and it is fixed over time, and let's say the market says, wow, that 8% is now attractive because I think that company should trade at a 7% discount rate or a 7% rate in their bonds. I'm going to go out and buy some, and people buy it and bid it through par until the net present value calculation makes it worth a 7% yield. Conversely, let's say you bought it at an 8% yield and the company hits some cash flow problems, and all of a sudden you're like, geez, this 8% doesn't look so fancy anymore. So you turn around, you try and sell it, and maybe the market, trades in the 90s for a little, but then there's different levels of distress, and you go 90s, 80s. Yeah, things are still okay. But there's an expression: when bonds trade in the 60s, they don't trade there for long. They either go into the 40s or go back to the 60s. When they go into the 40s, that essentially means they're going to declare bankruptcy. And here's an example of sometimes equity analysts get out there and say, what about the equity of Hertz? Wow, that equity looks somewhat exciting. What if Hertz makes it through? Hey guys, check the bond price first, please. If the bonds are in the 40s, do not go out and buy the equity, despite what any analyst tells you,
Right.
including some editors of some very influential financial publications. These are horrendous advice of people that have not checked the capital structure. And I want to add one more thing. Why did the Fed get involved in high yield bonds for the first time in the history of the Fed ever saying they are going to, get involved in different markets? They picked high yield bonds this time, this COVID crisis. Guess why? There are four major American companies that if they got downgraded from their current cusp of investment grade into the junk bond or high yield market, they would overwhelm the high yield market. Those four companies, Ford, General Motors, General Electric, and AT&T combined have more debt than the entire high yield bond market. The Fed
What do you mean they would overwhelm?
Because their combined debt is greater than the combined high yield market in total.
Okay.
Can you imagine those four guys coming into the high yield debt market? The price of the high yield debt market would get destroyed.
Right.
The elephants are in the room. Okay. And these downgrades, they're forced selling coming out of investment grade accounts. The Fed had to walk into the market to stabilize the market, to be able to buy it in case these companies got downgraded from high grade to high yield. Sort of scary, but once again, I need to tell you, you have to understand where the bonds are trading before you worry about the equity.
Right. Yeah. Now, I mean, that would be typical what you should do, right? In a sense where I like to kind of use an analogy like playing blackjack. So a very simple game.
Okay.
You draw two cards and you try to get 21. If I drew a 19 and I was feeling really lucky and I took a hit and I got a 2, I win. But that wasn't the right move, because if I play that way over a long period of time, I'm going to lose. And so, kind of to your point, even though the bonds are saying do not buy this stock, GameStop, for example, people did buy the stock and they made a lot of money.
That was a technicality, and there's enterprise value versus enterprise value being the value of the market cap of the company, the equity market cap plus the bonds gives you what's called an enterprise value. You're totally right. That's a technicality, but on a basis of risk return,
sure,
you're not supposed to say hit me when you're at 19. You're not supposed to run in and buy, but life is a probability analysis. Okay. And sometimes you say hit me, and sometimes you draw another ace, and maybe then you say, hey, I'm going to see if I can get that one last ace. And that's a 4 out of 52. It's a 3 out of 52 chance. Assuming the dealer doesn't have an ace as well, there's a 3 out of 52 chance I'm going to get hit on another ace. Like, you can do that if you want, man. But look, that's not what you're supposed to do. Life is a game of probabilities. It's a game of smart investing. And that's exactly it.
Yeah. And if you can get lucky, but like I always like to say, like my wealth, my future is too important to leave up to luck. So you play the odds, right? You play the strategy that you know will
Please
win.
do. That's it.
Yeah.
All you can do is play probabilities. And that's why I always look at things on an expected value basis. That means the probability of some outcome times the value of that outcome. And you have to add these probabilities in good cases and bad cases, and you come with an expected value. That's correct.
Right. And just like in that blackjack game, you have to be okay. You're going to lose a couple hands, but you're going to win. You lose the battle, win the war, kind of a thing, right? So,
How about this? If you're if you're on the dealer side, yes, you are going to. If you're on the other side of the table, you better be a really good card counter, because you
yeah,
generally don't. The house always wins. Okay. But let's not get into that.
sure. We won't get into that. So, per kind of this example that you were giving us, then, I guess from the outside looking in, and you see the government coming in and propping up the bond markets, and then bailing out, the airlines, for example. And I think a lot of people look at that and say, well, they don't want to have all those people go unemployed, right? They're trying to save jobs.
Yeah.
But you might be coming from a different angle and saying, no, they weren't trying to protect the jobs. They're trying to protect the markets from imploding. Is that maybe accurate?
Hey, look, that could. So airlines typically are high yield borrowers. There's some good ones. Southwest is not high yield, but a credit rating is a function of the cyclicality of the business. So there's something called business risk in every analysis. So there's an argument that a steel company, for example, is limited to the maximum credit rating to which it can aspire just because of the business risk. Airlines are the same thing. You need to understand that there are cyclical industries, and that cyclicality of an industry is risk, and you call it a business risk. And then if you start tacking leverage onto that cyclicality of the business, that increases the risk, right? And those are the components of things that go into a credit rating and a credit analysis of whether you should own that. So yeah, they were worried about the employment, but it's also the fact that there's a lot of airline bonds out there that are in a high yield index, and they open the door to them being able to buy high yield. And therefore, there were people out there that says, well, maybe I should buy high yield before the Fed is buying it, because I know I'm backstopped by the Fed. Come on. Of course, there's people that front run it. So yes, that's what happened.
So let's talk about, let's take this and kind of give a bigger picture of like where we're at right now, and then maybe kind of transition to kind of like where that goes. So, with rates dropping like crazy, pushed, and then we kind of have two phenomenons, right? One, rates and yields are dropping, and at the same time, you have the largest segment of the population, the baby boomers, are retiring, and they need income. So it's like they need income, but rates are dropping. You have all these pensions and stuff that have built this model off of this return they're not getting, and it seems to me, and you correct me if I'm wrong, but it's pushed people out into riskier and riskier assets. And so now we have a lot of people with exposure to these markets that are pretty dangerous, it seems like.
Okay, there's a lot in there. How about this though? We start with bonds, and we'll say that, okay, for 40 years, when I started trading in 1988, interest rates were at 14% in the US. Okay, and they had come down from 18% the prior years. 14% in 1980s, late 80s, and they bottomed out at the end of the COVID crisis, or right at the COVID crisis about a year ago, at 60 basis points. I'm talking U.S. Treasury 10 years.
10 years, yeah.
Essentially, that is a 40-year bull market in bonds. Okay, why is it a bull market? Well, because interest rates falling they do make bond math. When an interest rates fall or come down, the price of a bond increases. Okay. And so all you're really doing though is you're pulling forward the coupons on that bond. But that being said, it's a very fluid market. It trades. So interest rates went from 14% down to under 1%, and now they've turned. Okay, so now the 10 years 1.5, 1.75. It's all a rounding error compared to 14%. Let me tell you, it's fun to own U.S. Treasury debt at 14%. I've done it, and it's quite easy. It's sort of comforting.
Yeah.
But what's happened? There's two things. Okay, so inflation expectations have come down, way down. So it was Paul Volcker in 1980, the beginning, where he had a war on inflation. He jacked up Fed funds rate.
Right.
So anyway, battled inflation. It's successfully come down. But my argument is this, okay, it's not going to be an inflation concern going forward. It's going to be a credit quality concern. Because what's happened in every single successive financial crisis that I've witnessed has been the risk, or financial leverage has been transferred to the government. from financial institutions. Okay. So 2006 to 2009, what essentially happened there with TARP, Troubled Asset Relief Program, and all this printing of money was the financial leverage in the big financial system, the Wall Street and the global finance industry was successfully transferred to the balance sheets of the governments. Right. Now, successfully, why do I say successfully? Because it saved the world. In 2009, we were on the brink. I cannot tell you how many days in March 2009 I rode the train to work, and I was wondering, is this the day that it all ends? Okay.
But did it didn't, because we can get into that, but the problem is still here and even bigger today. It prevented it from happening at that time.
Correct. Right? And what happened was the leverage again, over-levered financial institutions, Bear Stearns, whose stock was trading at $125, was sold to JP Morgan at $2. And guess what? It was probably worth minus $25, easily minus $25 or more. Okay. Because the leverage in that bank, if you had marked that to market, it wasn't worth anything above zero, but the Fed engineered a trade and got something to happen. Other things got transferred to the balance sheets of the Fed when AIG was about to fail. And the Fed stepped in to rescue AIG, because if AIG had failed, Goldman Sachs would have failed. And the domino effect would have this is what I'm telling you. It didn't happen. And they pulled out all the levers. And there's no question they did everything they had to do to save the system. But what did it do? Caused more money, caused leverage to be transferred from the financial system to the balance sheets of governments.
Yeah. Yeah. And I think that was the first time we really started hearing that too big to fail argument was right there around.
Isn't that interesting? Because I learned it in 1986 at Cornell, in Cornell University.
That's when the public got it.
It's funny that my professor, I remember specifically, she cut the article out of the magazine. So there was some magazine that was talking about too big to fail back in 1986. Might have been some esoteric financial publication. I don't remember what it was, but memory serves. It was something like Forbes or something like that. So it doesn't matter. It was big enough that it just wasn't part of the lexicon. I'll agree with that.
Yeah. And so, it was that leverage that was the problem. The other thing was, I guess, and this is kind of a different, well, they're all intertwined subjects, but I mean, when those people weren't held accountable, then it allowed them to leverage back up, as opposed to me,
crazy, right?
As a real estate investor, I got completely wiped out, and I am still shell-shocked over that. And my whole investing for the last 12 years has been completely different because of what happened to me then. But for them, they haven't, which then they just basically went back into the same actions.
Socializing losses, right? So nobody was held accountable. No one was thrown in jail. There were just so many atrocities. And who ends up paying for it? The public. But that's when capitalism is not allowed to cleanse itself, i.e. you socialize the losses, you bail out long-term capital management, because, that's what we do to our friends. I'm not saying there was any crony capitalism there, but I think you'd be surprised if there wasn't. Look, yes, it is so dangerous to socialize losses, because that's what capitalism is actually weeding out the weak players over time so that the surviving players are stronger. Right. Otherwise, you just get a bunch of really weak players and you end up in a situation, and I hate to say it, but sort of like where we are right now.
Yeah. So it seems like watching this and more from the outside, not from the inside, like you've kind of been participating in, but it seems like, the central banks, the Fed, the central banks, they kind of have tools at their disposal: monetary policy, fiscal policy. So, basically inflation, or I'm sorry, interest rates and debt creation. And it seems like we're seeing their tool chest empty out, in a sense where interest rates are basically at zero.
Yes.
And debt is at levels that can't be seen. And it seems like their back is against the wall right now, right? Where it's like the debt is so high and everybody requires so much debt that rates can't really go up. But at the same time, they're, trying to protect the currency, maybe. And so they're kind of stuck. Like, do we save the bond market? Do we save the currency market? And like, are they trapped?
So the two are intertwined. Yes, they are. It's very simple mathematically. It is impossible. It's mathematically impossible for the currency not to debase, because your debt burden right now, just to service the debt, is higher than your tax base or your GDP can possibly grow. Okay,
Right.
I could get into the granularity of that calculation, but I term fiat paper as the error term which solves the debt DEBT spiral. Okay. The debt spiral is that the numerator, your total debt, to your denominator, your gross domestic product or your tax base, is so large that even the coupon on the debt cannot be serviced by the growth in the GDP.
Right.
Very simple math. Unfortunately, too many people have failed math, or they just take for granted
Right.
that, hey, it worked in the past, it's going to work going forward.
Yeah, I did a video on that, the debt spiral, and I was kind of talking about the debt to GDP level and the Keynesian multiplier, which states that if once a country gets over 90% debt to GDP,
Yeah.
that they're not getting enough growth for the debt, and obviously now over 125, 130.
Okay, I'm gonna add the fuel to the
please.
fire. It's 4. Okay, the total global debt. I'm not talking government debt. Total global debt.
So is that like 300 trillion?
So it's over 300 trillion, but even if we went with that, okay, total global GDP around 990 trillion. So 300 trillion, I think it's a little bit higher. So let's just say it's 4 times. Okay, total global GDP to close. Correct. Total global debt is 4 times total global GDP. Okay. And why is that the important metric in my mind? Again, I'm a bond guy. Interest rates and interest expense are tax deductible. It does not come out of your tax base, meaning you can't tax it. Okay. And therefore, that's the leverage that you need to be concerned about. More importantly, when they keep recycling that debt, moving it from over-levered companies onto the balance sheet of the governments, hey, it's just going up no matter what. So it'll grow organically just because of the coupon on the debt. It'll grow because of these monstrous deficits that they're announcing to keep us out of recession or economic depression.
Right.
But mathematically, it's impossible for the tax base to keep up. It's just, again, it's only math. I'm sorry if it offends anybody, but it's only mathematics.
Right. Well, some people 2 + 2 doesn't equal 4 anymore, so they're not understanding that. But math, I love math because it's fact, right? It's
the base layer of language. Okay, that's what I love to say. Mathematics is the base layer of language. Everybody, no matter what language they speak, if they understand math in Chinese and they understand the same math in American or Canadian or English, that's the base layer of language.
Yeah. And you don't even need language. I mean, you could just put some objects on the ground and 2 over here, 2 here.
It's like, it's about time. It's about time we say it. Yeah, it's like Bitcoin. The base layer of Bitcoin and the base layer of language are both mathematics.
Yeah.
Bingo.
Yeah. So there's a good tie-in. So let's kind of start transitioning into that. So where does this go, right? So if rates are at 0, and debt is already so high that it can never be paid back, I guess one side would be a bust, which you said got saved in 2008, and how bad that would have been. If it happens today, it's going to even be way worse, and that's going to be bad. Maybe the only other option I see, which is not a good option, was some sort of like a debt jubilee. And maybe through some sort of like SDR currency basket, they kind of manipulate some sort of global debt.
Seems like it's happening a little bit right now.
Well, it is anyway through more debasement, right? One way or another.
When you said SDR, though, you meant special drawing rights, right? The IMF's special drawing rights.
Yeah, well, I did a video on like the secret money layer is what I call it. But
cool.
But basically, each country has their own fiat currency, and then SDR is like a central bank of all central banks, and now they're just doing this new 650 billion.
Okay, it's good. It's gimmickry. It's all gimmickry. Okay, look. First thing, I'm gonna say something. All right, all fiats, and there's 180-ish of them in the world. They're all melting ice cubes. Why? Sure. Because they're all in the same situation where the fiat currency needs to be printed to solve the debt spiral. Are we going to call it a death spiral? Not for G20 countries. Maybe Turkey, which is a G20 country, may be suffering a death spiral. But let's just assume a debt spiral. There are other countries that require IMF help all the time. They're the bottom. Unfortunately, I live in Canada. I'm a very lucky man, but we're not the United States. Canada will fail before the United States fails.
Sure.
But if Canada fails, the US isn't going to get off scot-free. Okay.
Yeah.
The US people might say, oh, geez, that's a pretty important country that just failed. So there's contagion. There's all sorts of different things that happen. But countries do fail all the time. Remember, when I got into this business, Brazil, Argentina, and Mexico had all failed. Failed what? Well, they failed to stand up to their obligations to counterparties to pay back their contractual debt.
Just like Greece, just like Puerto Rico, where I'm at today, right?
Mhm.
They failed on their bonds, same deal.
It's happens. That's what I call, when it fails and there's no bailout, that is capitalism. That is, you lick your wounds, you come back, you write off your stupid investments. It's it's constructive. It's painful, but it's good over the long term for creating new upcoming companies that are better at managing their risks. Now, countries, on the other hand, are a little more difficult. It's not like a country will replace another country, like a company can replace another company, right? So this is where the difficulty happens. And this is why I'm so convinced that people need to start focusing on the credit risk of countries, not on the credit risk necessarily of the biggest corporations, although the two are intertwined. But everyone's always said, oh, this treasury is only inflation risk. No, guys, that's not the case. There's credit risk in there. There always has been, but now there's really cool markets called credit default swap markets, which will actually give you a daily price on how much it costs to insure yourself against a potential default of various countries.
So how should regular people be thinking about that? Or you said even watching that?
They can
When
watch
I say regular,
it.
I mean like, retail.
Yeah. Well, there's a web page. I think I sent it to you, but I can link it. You can link it to this podcast or whatever. It's global CDS rates by country, and then you'll see the neat premiums they have to pay. Right now, Turkey's at the bottom of the stack in terms of credit quality, and rightly so. But it's a G20 country. I mean, this is dangerous. And then there's some Latin American countries that are also included in the G20 that have had a history of serial defaulting. Serial, SERIL, not cereal like you eat. Okay, they're a serial defaulter, and hey, but they're there, and eventually there's contagion, and this is what I'm so scared about, because eventually the gig gets called, and I saw it in 2007, 2008. Okay, Lehman Brothers fell so quickly, the confidence got lost, and nobody was out there in selling insurance on Lehman Brothers. They only wanted to buy the insurance. They saw the house was burning and they wanted to buy insurance. Well, that's not when you buy insurance. You need to buy insurance before your house is burning.
Yeah. So I've made the case that in many videos that I've done that the gig is coming to an end, right? Like I've already made the case, like their toolbox is running out of tools.
Okay.
Like they can, can they roll the 30-year into a 50-year into a 100-year bond? I mean, right, at some point, like this comes to an end. But I've kind of made the case that maybe they're only kicking the can down the road. Maybe they're only keeping the game going until they're ready to make a switch. And maybe there's like this point coming where maybe they want to transition into this new system.
I need to put myself in your chair, and you need to understand how lucky you are sitting in, well, you're in Puerto Rico now, but you're in the United States, right?
Yeah.
Puerto Rico's not even a state. It's a republic,
it's a territory.
Or something, right? Territory. Okay. So it doesn't matter. Doesn't matter. You're sort of part of the United States, but let's just say people in the United States are so darn lucky, because every single other country and currency will likely fail before the US. Okay. Right. So you can say everything you want about what the Treasury is doing and what they have to do, but if you start seeing things falling, dominoes falling all around you, people in the US are not stupid. They're going to be like, whoa, geez. I mean, imagine Canada. Okay. So up until a few years ago, Canada was the US's largest trading partner. We do not have a European central bank backing us. Okay. So Italy is a basket case. So is Greece. So is Spain. So is Portugal. But they have the ECB, the European Central Bank, backing them. Canada doesn't have, we have swap lines with the US, but we don't have an implied guarantee from the US to bail us out. The US may be wise to bail us out. Don't take that the wrong way. Okay. They would never be wise to bail Canada out. But the point is, if your largest trading partner falls, or your second largest trading partner falls, these things disrupt finance. There's a lot of counterparty risk. There's a lot of contracts that go unfulfilled. Just remember that the luxury that you guys have. So what could happen in the US? Well, you could see the spreads or the default premiums on the United States widening, indicating a greater risk of default, but I don't expect it just to happen overnight. This is going to be something that gradually ticks up. And then there's going to be countries around in different spots that, oh, this one just fell, this one, Turkey only has about a 7% chance of default, according to its credit default swap spread right now. But just like bonds that I said, they don't stay in the 60s for long. CDS right around 500, credit default swap insurance right around 500 basis points annually. My experience is it doesn't stay there that long. It can blow out to wider levels, and that causes the contagion within that country or within people who have been selling protection on Turkey. They finally say, oh, Jesus, I'm really in trouble. I got to be a buyer now. Or how about this? They Texas hedge themselves. I can't, Turkey's going to go down. So I need to get protection on another country that's going to go down. So they become buyers of Brazil. Okay. Right. So they couldn't protect themselves on Turkey, but they run out and they buy protection on Brazil. So all of a sudden there's now a fire in Brazil because there was a fire in Turkey. Okay. This is what happens. It's called contagion in credit, and it happens like scary fast. And have I witnessed it? Yes, many times. And there's that pit in your stomach when you're just like, there is no hedge until what was our hedge?
Yeah. Bitcoin, so let's talk about that. So, what I'd start with was to say that if or when this all kind of comes to a head, whatever some event happens or they decide to make it happen, it's going to be pretty painful for a lot of people. As you said, like in 2008, they saved the world. I mean, it would have been really bad. But we have a life raft. We have like an outlet right now, which maybe one, I want to throw this out there. Maybe one, it helps us as individuals where, hey, I can sidestep this, you can sidestep this, but it's going to be bad for most people. But maybe it actually helps soften the blow for a lot of people if enough people jump into the life raft. You want to talk about that?
I'm going to have to, I sort of think I know where you're going. But,
well, what I mean by that is, let's say that you and I are okay. We end up with a bunch of money and the whole world burns. Well, that's going to suck for the whole world.
No, it's going to suck for us too. Okay. Come on. Let's be honest.
Yeah. I mean,
don't forget. Okay. What could happen in that case? Like, the people turn around and they're like, there's bands of people that cannot feed themselves. They start, and I don't want to use that. I don't want that to happen.
No. And wealth is goods and services. So if nobody's out there producing goods and services, we can have all the money in the world. Does us no good. If you and I are on a deserted island with $1 billion in a suitcase, but nothing to spend it on, we're not rich.
If this transition takes a while and enough people start exiting to this extra system, maybe that helps soften the blow. Half the people are able to kind of protect some of their wealth. Well, the whole world doesn't crash at one time.
Yes, it's great. Okay, so I see it now. There is going to be, in the ideal situation, okay, I'm going to paint an ideal situation because sometimes I am an idealist. There will be a parallel system, okay? Fiat will be necessary to solve commerce, okay? But you're going to have to keep your store of value in other hard assets, one of which is Bitcoin. Why? Because it's transferable, portable, divisible, uncensorable, certified or verifiable, all the things. It is the beautiful part of a store of value. It's a technology, as Mr. Breedlove or Ross Stevens from NYDIG eloquently penned. Money has always been a technology for storing the value of your work or your time or your energy expended today to be consumed in the future. Well, don't keep that energy in fiat, okay? That we've already mentioned is a melting ice cube. Can that melting ice cube continue? Yes, it can. Do I hope it does? Yes, I do. Does it mean I want to store my money in it? No, it doesn't. It's only So there will be a parallel system. And what are we trying to do therefore? Help people move their money out of a mathematically programmed piece of money called fiat, mathematically programmed fiat to debase into a technology called Bitcoin that is mathematically programmed to be hard capped at 21 million. Does that mean the number goes up? I think there's a good chance that the number continues to go up. Therefore, I'm going to protect myself.
Hey, sorry to interrupt this video just one more time. I'm not running Google ads, so it's actually way less interruption than I normally would have on a video. And that's because it's sponsored by BlockFi. They are opening up the world of Bitcoin and financial products, offering to pay you interest on your Bitcoin, better than owning a rental property that you have to manage and control and have the risks. You can just earn interest on it, or you can leverage against it. Now, I plan to hold my Bitcoin forever and literally never sell my Bitcoin. So how do you do that? Well, if I need money, I don't want to sell that Bitcoin. I'm going to pay tax on it. All right. I'm going to end up with less, and I don't have the Bitcoin anymore. So a better way to do it is to borrow against the Bitcoin. So I've put all my money into Bitcoin. If I want to buy a car or I want to buy a house, I can borrow against it at very, very low competitive rates, get my house, get my car, whatever that may be, and get to keep the Bitcoin. Now, I've done a whole video on this. You can find it. I'll link it down in the description below, how to retire off of Bitcoin without paying taxes. And you can do that with BlockFi services. I'll link to the video down below. I'm also going to put a link to BlockFi. If you choose to click on that link to check them out, you can earn up to $250 in free Bitcoin just for using that link. And that's it. Let's go ahead and get back to the interview.
Yeah, well, you need two things, right? You need scarcity, which is obviously one important aspect, but then you need utility. So if you and I were on back to that stranded island, and we found like the only black rock on the island, well, it's not really worth much money. But if there was only one bottle of water left,
yes,
that's worth a lot of money. So it's that, and I think Bitcoin can fulfill both of those. But I think you had said earlier, and I think this was a great point. You had said really it's like purchasing power, and so I think a lot of people get caught up in fiat currency and mediums of exchange and stores of value and all those things. But really, we're just always trying to protect our purchasing power, or to your point, money is the technology to preserve my power into the future, right? And so I decided to work an extra couple hours today. The first 8 hours covered my basic needs. I worked 4 extra hours, and I can now store that energy I've exerted to go spend that later in the future. And we want to store it in something that's not losing, that's not slipping, right? And so
I'm going to add one part. As an engineer, you want to store it in digital energy. What is Bitcoin? Bitcoin is digital energy. As Michael Saylor says, it's the first law of thermodynamics. It's conservation of energy. So when I was 20 years old and I had a summer job and I'm out in the hot sun and I earned $20 for the whole day. Okay. Not an hour. For the whole day, I earned $20. Okay. And I was sweeping tennis courts. That was on a clay tennis court. I was sweeping tennis courts and I made $20. And do you think when I want to use that $20 in another 10 years, do you think it's worth anywhere close to the $20 of effort I put it? Come on. So I want to store that time, power, or work, both are interchangeable, energy in something that will maintain its value. My belief is that value is maintained beautifully in a system, proof of work system called Bitcoin.
Yeah. Yeah, it's kind of a simple subject, but most people have never really thought about it that way, right? Where everything boils down to energy. And Michael Saylor did put it really good in that perspective. Where and you just did in your analogy too, right? Where like you worked on sweating your butt off sweeping those tennis courts, and you're exerting energy, and then we want to store that energy for future consumption, which is a perfect way to lay that out. Yeah. So I guess, so we have this perfect store of value, and we could go into that. But when you're seeing all this trouble on the horizon with this bonds and whatnot, and a system, as you said, even the fiat currencies programmed to lose value. I mean, the Fed's targeting 2%. We know it's higher, but they're targeting 2%. That means you're losing 2% of your value every year.
Go with the growth of the money supply is a much better,
sure.
Come on, if there's $10 outstanding and all of a sudden there's 20 of these dollars outstanding and the economy hasn't really changed that much, that $20 is arguably may have been worth 12 old dollars, but it's certainly not worth 20 old dollars, guys. Come on. Your house, I've used this before and seems to your house is not going up in value. Okay, ladies and gentlemen, your unit of account or your purchasing power in fiat dollars is going down. Okay, that's all there is. It's the same thing, hard assets.
Yeah. So it just takes more dollars to buy those things today. And that's why when you really kind of keep going back to that purchasing power, you can see things differently. I don't know the numbers off the top of my head, but let's say, a median home price in the US in the 1950s was $50,000. Today it's $250,000. But if you look at that price of home compared to other goods, how many barrels of oil, how many ounces of gold,
Yes,
how
yes,
many
a good
bushels of
way.
wheat, right?
Exactly.
And then you look at
Yeah.
the average home price. Okay, how many ounces of gold today? How many barrels of oil? You would see that the house hasn't really given you any more purchasing power, even though it's worth a lot more
So
dollars.
sort of a pretty cool way. Yes, exactly. And that's called relative value. Everything, when Indians, North American Indians started using wampum as currency, there's a reason that they valued that. It was because there's that joke. Have you heard the joke where the guy is he's got a cow for sale for $600,000, and he's walking through town with there's a for sale sign on the cow for $600,000,
I've
and
never
all the
heard it.
towns okay, so the townsfolk are yelling at him, dude, you'll never get $600,000 for that cow. You're out of your mind. And about 5 days later, he's walking through town and he's got 3 chickens. And someone said, I told you would never get $600,000 for that cow. And he goes, darn right, I did. I got 3 of these $200,000 chickens. Okay. It's only a unit of account. Okay.
Yeah.
You have to understand everything's relative,
Yep.
relative. So, yes, comparing your house to oil is pretty smart. It's even better to compare it to Bitcoin. Okay. And, Bitcoin's only been around for just over 10 years. So you can't really do that, but it's the same principle. And this is why I'm sold on this technology as being the most beautiful store of value that I've seen in 32 years.
To expand on that, that's a great perspective. Everything is a trade, right? So it's always a trade-off. I'm trading one thing for
Yes.
another. And I believe it was Mises that said that in economics, there's no such thing as a constant. And so in economics, everything's always changing, right? The supply of houses are going up down, the supply of oil is going down, the supply of gold is going up down, the fiat currency, everything's moving. And so Mises said in economics, there's no such thing as a constant until now. Now is the first time maybe we've ever had a constant that can be applied to be that denominator in that unit of account.
So I think that's a wonderful. So I haven't studied Mises, and I know what I know, and I know what I don't know. But I will tell you that it's important, always extremely important, yes, to understand your unit of account and supply of that unit of account. Now, gold is really interesting because gold grows at about 2% a year, which is not a very large amount. But the thing that always struck me as an engineer, did you know that there's 20 million pounds of gold in seawater? And the way that we are technologically advancing our abilities, engineering and everything like that, it wouldn't surprise me that we determine an ecological way of removing gold from seawater at some point in time. Right now, there's lots of arsenic and everything required to do it. It's doable.
Yeah.
And there's
Yeah.
just minute concentrations, but I'm not putting it past anyone, and I'm not dissing gold. Okay. Gold is way better than fiat. Don't get me wrong. Okay. Gold is way better than fiat. I just happen to think that Bitcoin is better than gold.
The problem that I have with gold, and again, I told you I've been a gold bug, and now I realize as a sound money advocate. But the problem that I have with gold, I mean, okay, we can get it out of the seawater, and maybe we're going to mine it off of an asteroid too, or whatever. Of course, the cost to do that would go up, and then it would change the price. But the problem that we have with gold is that because of its size and its weight, it required centralization. And the centralization, as I say, always leads to manipulation. And that's exactly what's happened. And so now there's no free market to the price of gold. So the price of gold is set every morning in London by a couple of guys in a room. And like, how is that going to work out? Obviously, we can tell just from looking at the futures market and whatnot that there is no real price discovery on top of the whatever, maybe 500 paper ounces for every one physical ounce. But then we have the price being, manually set. And so while to your point, the inflation rate is decent, right? 2%, 1.5%, whatever it may be. Just the fact that it's manipulated, it's controlled, it's been captured.
And the bigger one is it can be counterfeited, right? Or it appears to be. I mean, how many times have you seen where they've actually, what have they painted up in gold paint, titanium bars or something? Look, I'm not saying this is happening, but when the gold standard, we saw the gold standard in 1971. Prior to that, the one European country, if I'm not mistaken, France might have sent its ships over to try and get the gold that it was owed out of Fort Knox. And okay, you're not going to get it. And therefore, he who has the keys has control. Okay. Okay, you're not going to get it. So yes, centralization, no question. If for the little guy, even if you store it in your house, in a safe or whatever, well, try and shave a few slivers off of that to buy your bottle of water that you need, right? I mean, and I'm not saying, look, I don't want this to happen, Mark. There's a way for it to coexist. It is just about understanding one, which is a currency for to be assumed instead of barter. So no one cow for 3 chickens. Okay, it trades for a currency, but that currency loses its value pretty reliably over time, and you just have to live with that. So you have to put your value of your work, time, and energy into something that will store that value.
Right. And again, you have a lot of choices. Obviously, some people are buying Amazon stock to store their value. Some people are buying real estate to store their value. Some people are holding
it. Unfortunately, Amazon, okay, might be, what is it? Is it Apple's a $2 trillion company. Amazon probably is. I have to check, but it's a top 10 global company. But it's $2 trillion. You cannot run the world off of an Amazon stock. Okay, like I know you can purchase stuff from Amazon, but that can never become a global reserve asset. Bitcoin can become a global reserve asset. Why? Think about this. If it's truly digital energy, do you think Russia actually wants, and they've proven they don't want, to have US dollars as the reserve? It's priced in US dollars, but they don't want it. They're trying to get euros. The Chinese are also doing the same thing. So there's this fiat currency wars. Bitcoin solves all this. Bitcoin, I believe, will become a unit of account for energy production or energy. I think there's a day that that energy, natural gas and oil will be priced in Bitcoin. It's only natural, okay? Because Bitcoin is digital energy. When that happens, the US could lose its, and I'm just going to even go as far as, they will have lost their de facto world reserve currency status. Yeah. Bitcoin, though, won't be the world reserve currency. It will be the world reserve asset. And there's a big difference because you can argue, okay, the Lightning Network's going to do all this and that, perhaps. But if we just go back to first principles, the store of value concept is what's important to the treasury at the Kremlin. They don't care that you can't, they don't care if you can buy your loaves of bread in it. What they care is they're storing the value of they have sold their valuable natural resources, and they want in turn a currency, they want in turn a payment in something that will store its value as well.
Yeah. And if we think about that, I mean, there's 2 trade-offs there. First off, money is power. And so, for them any government or central bank to relinquish that power to create money, it's pretty tough to imagine them ever doing that. However,
so the Russians, though, they would take it as payment because it's better than US dollars. They don't control the US dollar.
Oh, sure. So say if a trading partner said, hey, we'll buy this, but we want to pay you in Bitcoin, they might take that.
Yeah. What do you mean they take it? I think they might go ship it in, but come on. I'm like, and then they'd say, hey, by the way, these US dollar valuing North Sea Brent, right? Like, why is North Sea Brent priced in US dollars? Well, I don't know. It's because the US dollar was declared the reserve currency status. It's also the biggest economy, so there's not an argument. But then China, here comes China. But look, let's get back to the first principles of thermodynamics and store a value using energy, and that's why.
Yeah, I also could see how it could create a lot of peace in the world, because now we have, Bitcoin is independent. It doesn't matter who owns it. It's non-political, so it's fair, right, across every ecosystem. And so maybe
let's even go. Okay, keep going. I'm sorry to interrupt.
Well, I was gonna say, so maybe even it leads to this much more open and peaceful world, in a sense where you're not having currency wars and people trying to devalue currencies against each other, and then risk of bonds and all these things. And so maybe it leads to something much better.
I happen to believe that. So beggar thy neighbor is a theory. They, I need to increase my trade with a country. We're both competing. We're in Europe, Central Europe, and we both sell the same product. And a third party country could buy from either of us, but it'll buy from us if we're cheaper. So we debase our currency so that we can export to that other country. Okay. Beggar thy neighbor. So what does Bitcoin do? Let's see, just look. So every progress in human history has basically been side by side with an increase in energy efficiency or energy, the power to create energy. And I believe Bitcoin is that same thing in monetary form. The key thing then is stranded energy resources in places in the world that otherwise wouldn't have civilization around it can all of a sudden be an attraction for a civilization such as, you're right now, typically big cities were built around ports of call for shipping. Well, there could be times when cities of the future are built around, I don't know,
energy sources.
Well, yeah, correct. Like this waterfall that just keeps flowing and you attach a turbine to it. Now, I know there's environmental considerations of building a dam and everything, but imagine these stranded energy resources that can bring different populations to develop these energy that's so far being unutilized. It's just out there and it's just part of the universe or part of the earth ecosystem that's not being utilized, and it's too far away from the ports of call because you cannot efficiently transfer or transmit electricity more than about 500 miles, right? They lose too much over those high voltage wires. So, there's just so much interesting stuff that could improve the economies of the energy grids and everything in every civilization. So yes, I'll agree with you. It could really, really, really change the world. You'll get a lot of these environmentalists that'll say, oh, that's just bunk. And I'll just say, look, Bitcoin doesn't actually waste energy. It consumes energy waste, even in hydro grids or even in grids, rather electricity grids that you think, oh, it's using a source of fuel. Those grids are built to operate at peak capacity. And these turbines are turning even if the people aren't using the electricity. Yeah. So it's stranded. Yeah. That is a stranded source of energy that can be used for Bitcoin mining, creating a revenue stream that otherwise would not be there. So many good things. I agree. It's hard to get people's minds around it, but that's where Validus Power, I talked about the flare gas opportunities with Validus Power, and so excited about that. And we did just today, our company announced a major deal with a Canadian Bitcoin mining firm called Hut 8 that they are taking 100 megawatts, and a lot of that, I'm not going to give you an exact percentage, and I don't want people to hold us to that exact percentage, but a substantial amount of that will be flare gas, wasted energy. Okay, that's just otherwise being vented into the atmosphere, either vented and destroying the ozone, or burned and creating acid rain and carbon dioxide, and yes, very environmentally harmful things. We can cleanse it. We can mine Bitcoin. We can use that stranded energy resource, and we can create wealth.
Yeah, it's amazing, and I love that. I told you I was getting involved in that space about a year and a half ago as well. And what I really loved about that is really just changing this whole narrative, because so many words I think are so often misused, and a lot of people now look at capitalism as a bad word. And so I've even tried to abandon even using that word, and they look at capitalism as a bad word and willing to do anything to make a buck and this and that. But the reality is that entrepreneurs or capitalists are looking to turn trash into treasure, right? They're not looking to waste resources. They're looking to maximize resources. And so to your point, I mean, you're finding an asset that's completely not even being used. And in the point you were making, not that it's not just being used, it's actually harmful to leave it alone. And you're going and capturing that and turning that trash into treasure, and at the same time, cleaning up the environment as well. And I think, unfortunately, the media, education, whatever you want to call it, has really put that bad kind of image in people's head. But capitalist and entrepreneurial type endeavors like you're working on are forces for good.
I think so as well. Was it Margaret Thatcher that said capitalism is the worst form of governance except for all the other forms, right? And she also said communism only works until you run out of other people's money. Okay, right. So there's definite arguments. There's people that lean to the left, people that lean far left, people that lean far right. I'll only say this: I'm a free market guy. I truly believe that open markets are the most effective way of increasing productivity. You're not socializing losses. You're licking your wounds when you lose money. You come back and you fight harder, or maybe you just blew it all on one shot and you'd ask the dealer to hit you at 20 and guess what? That ace didn't come up, okay? Like you just cannot live your life with no economic consequences of taking undue risk. Bitcoin, on the other hand, is a risk that I'll state, if you don't own it, if you don't own Bitcoin, you're taking more risk than if you own a 5% portfolio allocation, okay? That is true. It's mathematically true. The asymmetric return opportunity in Bitcoin is the best trade I've seen in 30 years. Am I 100% certain? I'm not 100% certain. But I truly believe that Bitcoin at this trading price is a rounding error compared to where it could go to. And in my opinion, where it's a higher likelihood than most people think it could go. All I'm saying is do your expected value analysis. You got to look at the global credit markets as a premium that people are asking or that people are paying to insure that debt. And you can just say, hey, the world's not all good, okay? There are a lot of people that are worried about a lot of stuff out there. And I can calculate the value of Bitcoin using credit default swap markets on sovereign countries that show me right now that Bitcoin today is worth between 110,000 and 150,000 US dollars per coin. That's intrinsic value to me based on something that I've spent 30 years trading called credit default swaps or credit markets.
Can you explain that, how you get to that number? That'd be great. I'd love to hear that.
How about how about every single country, you could walk through the math that I'm going to walk you through for the United States of America.
Okay.
The US has about $30 trillion of outstanding debt, and they have another 160 trillion of unfunded liabilities. That's Medicare and Medicaid, okay? Let's round up and make the math easy. Let's say there's $200 trillion of US, and why is it gonna make it easy? Because there's state, municipality, and all this other debt in there that's de facto, somewhat a federal obligation. So there's $200 trillion US, okay? Currently, the CDS market on 5-year US CDS, credit default swap, is about 10 basis points. Okay. So 10 basis points means, in layman's terms, it costs you $10,000 a year to insure $10 million of US Treasury debt against default. Pretty small premium, but it's greater than zero. I'll remind you that Lehman Brothers traded at 9 basis points in 2006, and that $9,000 annually went to $6 million on 10 million bucks. Okay. So this is what credit default swap markets can do. I'm not saying, again, please, ladies and gentlemen, I'm not predicting this for the USA. There'll be many other countries, but I'm just using USA as an example. So 5-year CDS is 10 basis points. We need to adjust that tenor for about a 20-year obligation, in my opinion. And there's no 20-year credit default swap markets. There's only 5 years. So if you adjust that market out to 20 years, is it fair that if it costs you 10 basis points in the 5 years, could we see some sort of yield curve? And it's not a yield curve, it's a credit spread curve, that it costs you 50 basis points in 20 years. I'll tell you, yes, I think that's a good estimation of where your 20-year CDS would be. So 50 basis points. What's 50 basis points times $200 trillion, Mark?
I'm not good at math. You tell me.
I'll tell you, it's $1 trillion. What's the value of Bitcoin right now?
1.2, maybe.
Doesn't matter. Let's say it's $1 trillion. Okay. Right now, you are only paying for Bitcoin that protects you for the US. You're getting everything else in the world for free. Every other single country in the world whose spreads or credit default swap premiums are wider generally than the United States, or right around it if you're Germany and some of the top quality countries. You're not Canada. Canada's at 37 basis points. Even if we have a higher credit rating than the United States, which we do, the market is charging us 3.7 times as much as the United States. Okay. And because it doesn't matter, a credit rating is a credit rating and a default premium is a default premium. Okay. So again, I just made the calculation that shows you are getting every other country in the world, default insurance on every other country in the world for free.
Yeah.
Even just calculating it off the USA. So what I did is I calculated off all some other major countries, G20 countries. That's how I came up with 100.
The G20 countries, the amount of currency they have, the
not currency, debt, the total,
the debt, and then the
total
default swap
unfunded
rate.
and the default swap rate adjusted for a tenor of a 20-year term.
And that brings it to what kind of valuation?
Again,
about
Bitcoin
a
between
2 or 3,
110 and 160,000. And I need to give you a range because again, my estimation of what a 20-year CDS rate would be is nothing more than an estimation. But I just ran you through the math for United States. Yeah. Now, again, United States is going to be the last country. If it fails, it will be the last fiat country to fail. But there's going to be tons of others. 170 other countries are in a very bad point. Tell me you didn't want to own some Bitcoin in Venezuela. Tell me you didn't want to own some Bitcoin in Lebanon.
They do.
Okay, yes, in Turkey, in Nigeria, in right now, India. India is a BBB- rated country. Isn't it interesting that a very credit fragile country is wanting to ban Bitcoin? It's sort of telling. Okay, so
capital controls, not new.
Okay, so I ran you through the math on just one country. So you do all of it with major countries, and I'm absolutely convinced this is the best asymmetric trade I've ever seen, because that value will change as the spreads widen over time too, right? Yeah. And it's not the only valuation metric. I was lucky enough today, Plan B actually was reading my paper and tweeted that he was reading my paper on credit, and actually said complimentary. So I thank you. I don't know who you are, but I know your work and your valuation models. Plan B, it's very it's one other valuation model that goes into it, but I can get to valuations of Bitcoin that will blow your mind, and then I just put a probability on that, and I just say by all measures, whether it is stock to flow using Plan B, whether it's the current value of Bitcoin versus the global credit default swap market, you got to own some. And I'll walk you through, if you want, where I think it can go to, but that's not important. Just buy some because it is insurance.
I mean, if you want to tell us, go ahead and walk us through it.
Okay, so my simple one is this. There's about $900 trillion of global financial assets. Okay, 900 trillion. That includes real estate, everything. It includes all debt. It includes all equities. It includes gold. It includes everything. $900 trillion. Okay, if Bitcoin ever became the global reserve asset, like I think it can, is it crazy to think Bitcoin could be worth 5% of the entire market? No, I don't think so, right? That's ridiculously small. So 5% of $900 trillion is $45 trillion. 45 trillion divided by 21 million, which is the supply of Bitcoin, is what? Oh, it's over $2 million a coin. Okay. Yeah. And I think that's low.
Yeah.
Am I 100% certain? No.
No,
but I want to own some. I want to own some, because if I do a probability distribution, and that probability distribution includes the possibility that it goes to zero, okay, I can put in a scenario, and I'll just give you a scenario that said you're still supposed to buy Bitcoin with your eyes closed.
Yeah.
And I real simple. I'll walk you through that. Let's say I give you, how about we settle on the fact that Bitcoin could be worth $2 million or higher with a 5% chance. Okay. Well, I'll give you a 95% chance it's worth zero then. Okay. That's a binary distribution. There's only two outcomes. 95% it's worth zero, and a 5% chance it's worth $2 million or higher. Well, as you know, expected value analysis says you take the price times the probability. So 95 times zero is zero, and $2 million times 5% is $100,000. Okay, $100,000 today. Interesting. $100,000 today, and that's also what the CDS on a conservative valuation is telling you it could be worth. Again, you don't have to take either model as being. It's just you have to agree with me. They are potential outcomes.
Yeah.
So you buy it.
I mean, there are other probabilities for sure.
That's correct. So you started this conversation off pretty neat with your blackjack analogy. And I don't play a lot of cards. I mean, I play enough but I'm not good at card counting, and there's ways but Bitcoin, if you were a card counter, it'd be hard for you and your probability analysis to say you should be short Bitcoin. Yeah. And if you own
and
zero,
if you're not long, you're short.
Attaboy, you took the words out of my mouth.
Okay. Yeah. Sorry. But yeah, if you're not
long,
no,
not
short.
Sorry. No, this is the Moss Foss team. Okay. So
yeah, that's right. That's right.
You took the words out of my mouth.
Yeah. And then, I mean, that's amazing. I haven't been to that math before. So I really appreciate you sharing that with us. That was really cool math. I've looked at it from a couple different ways to kind of back into that. But man, if you look at the bond market, I mean, I don't know what it is today. What, $18 trillion of negative
yield? Yeah, I mean that in itself is just another.
That's like worth less than zero, right?
It actually is. Well, it's not worth less than zero. It's you're paying somebody to borrow money from you. Wow, that's a pretty cool thing. Yeah, I'm gonna borrow money from you if you're paying me for it. So yeah. Go ahead.
Yeah. So I mean, yeah, just look at all that. But this 900 trillion. I mean, that was great math. I really appreciate that.
Well, you know what? There's so many different ways, and remember it's a continuous distribution. You have to, there's guys that are out there. Well, I guess Plan B calls for $100 trillion valuation, right? And I only used a $45 trillion valuation, but $100 trillion valuation divided by 21 million, I guess, is over $5 million a coin. Look, you just need to do some research. Most importantly, you need to understand the beauty of the technology. Anyone who talks down Bitcoin that has never sent money on a Bitcoin wallet from one point to another really should not even be in the conversation. Okay. Because they'll just say, oh, it's a Ponzi, this. I know. If you're able to transfer value over a distributed ledger with no intermediary besides the decentralized system, that is the most beautiful thing I've seen as an engineer. I've sent money to New Zealand, not even knowing the counterparty, having met the counterparty I knew was an indigenous tribe in New Zealand. I've sent money to them and it settled in 10 minutes. Try doing that with an international money wire.
Try doing that with gold.
Attaboy, same thing, right? Same thing. So, we could go on and on and on and I just need people to peel a layer of the onion, do some math. That is the key, because that's all Bitcoin is math and code. So you need to do some math. You need to understand mathematics, and then you got to do some probability analysis. Nobody can ever be 100% certain. Very few things are 100% certain in life. Okay. And
only two, right? Death and taxes.
Well, and maybe now not even taxes. If you can print money, why pay taxes? So anyway, let's leave that one on the side for now. But look, Mark, it's getting there, but we're still so early. I've been lucky enough to be invited on a number of podcasts, and with podcasts come hate mail, and the hate mail is okay until you realize how really intellectually lazy some of these people are.
Yeah.
And the FUDs out there and everything. If you have children, you owe it to your children to do the work of understanding what Bitcoin is.
Yeah, that's so good. You absolutely do. And I believe it's sparking the new Renaissance 2.0 because I think it's kind of carrying on from the internet, right? The internet allowed information to be spread. And really what I've seen from people with Bitcoin is it creates all this curiosity, and they start digging in these rabbit holes, as we call them. And they start learning all these things. There are a lot of intellectually lazy people as well, but I'm more happy about seeing how many people are actually waking up. Like the word fiat currency wasn't even ever used hardly.
Isn't that amazing, isn't it? Yeah, I agree.
Yeah, so it's a renaissance for sure. But man, Greg, that is so much good information. I think we could probably wrap it up with that.
Sure, that's awesome.
That you gave us, and
I love that. And by the way, but the math is easy. Well, not easy, but you just got to get the information, and you also got to remember that you stated it. If you own 0 Bitcoin, you're very short. Okay, because what if? And markets are truth. And I know it's been the best performing asset over the last 10 years. And Goldman Sachs today or over the weekend started including it on their portfolio allocation or attribution summary. If you look on Zero Hedge, they had a really cool tweet on that. Let me tell you, there's a lot of portfolio managers out there that are going to be like, look, I cannot avoid considering this as an investment alternative anymore, especially when a very respected house like Goldman starts putting it on their attribution reports. Okay. So,
and what's crazy is so many financial advisors and funds still can't even buy it.
it's moving in the right direction. Look, I told you,
but I mean, that just shows how early we are, right? Like they're not even legally allowed yet.
Isn't that unfortunate? Legally allowed, eh? So it just means that the firm doesn't facilitate it for you, but being legally allowed to do something, that's a big word, because that means that you're not dealing with a counterparty that has your best interests in mind. Anybody who tries to restrict you from doing proper risk management, you should drop that counterparty. Okay. And I'm not sure if we mentioned this at the intro, but I was involved in a company in Canada that brought the first exchange listed closed-end Bitcoin fund to North America, listed on the Toronto Stock Exchange. And we took the Ontario Securities Commission to court because they initially refused to allow us to get a closed-end fund. We took them to court, we won, and God bless the I'm going to call it judge, it's not quite a judge, who said, look, it's not our job to tell the public what to invest in and what not to invest in. We just have to ensure that it is a market that can be effectively reproduced on a closed-end fund basis. And what happened then is the closed-end fund morphed into them having comfort in an ETF, and Canada beat the US to the ETF market for Bitcoin again. And, you could go and have your brokerage house in Canada that says, no, you're not allowed to buy that ETF. And the smart guy will just say, what? It's my money and I want to buy it. And you're telling me I'm not? Pack up my accounts. I'm taking it across the street. That's not always the easiest thing, but it is doable. I'm taking it across the street because my friend works at another institution that does allow us to buy this. And you're not supposed to tell me what I'm allowed and not allowed to do with my money.
Yeah. My sister-in-law works for Charles Schwab.
Okay.
And they are not even allowed to mention it. They can't refer clients to anybody else. They're completely prohibited from even talking about it.
I wonder what Mr. Charles Schwab would have thought of that. I don't think he's still alive anymore, right? But I'm almost certain that's against his investing principles. Almost certain, because again, it's not the advisor's job. It's the advisor's job to advise. It's not the advisor's job to limit or to restrict. And if it is limiting or restricting, perhaps that advisor failed mathematics. And then you should ask the question, so you failed math, eh? And you're advising people how to invest? Perhaps you shouldn't be my financial advisor.
Yeah, that's a whole rabbit hole we can go down.
I don't want to. Sure, I don't want to, because I get enough hate mail now. Actually, I don't get too much. I'm Canadian. Luckily, some people like Canadians, and other people can't even find Canada on a map. So maybe I'm okay from that.
I don't mind the intelligent hate mail, and it's not hate mail, but I probably get 5,000 comments a week between all my platforms, and it's such a good way to sharpen your viewpoint. But also, I'm open to change my mind, right? And I love the discussion. I'm open to change my mind. I get a lot of stuff that says you're an idiot. You know what I'm talking about.
Okay, so here's the truth, right? And that's what you learn in 32 years in the markets. One thing you need to understand is if you're wrong, you need to switch direction, okay? Or else you'll get wheeled off the floor. They cart you out, okay? You're done because your stupid stubbornness to realize you're on the wrong side of a trade just cost you a career. Right. And I'm open to that. I'm open to absolute criticism that is that is warranted. Not stuff like you're boiling the oceans, and not stuff like it's a Ponzi scheme, and not stuff like what's it good for. There's no intrinsic value. Oh, the network itself, the most powerful computer network in the world, has no intrinsic value. And there's Canadians and influential Canadians that are saying that. Now I can understand why Jamie Dimon started saying that, because he knows what Bitcoin's going to do to disintermediate or disrupt his company. So he's somewhat biased, but for the regular person out there who needs to protect their wealth, we don't need to go any farther than this. Do some mathematics, understand that Bitcoin is digital energy and it is a store of value. In my opinion, it offers the best asymmetric return distribution that I've ever seen in 32 years. put a probability on that, and we'll go forward.
Boom. And with that, we're going to call it a wrap. Greg
Giving
Foss,
you
Mark Moss.
the hang loose, because I understood you're a surfer and we do the we do all these goofy little things. But yeah, I'm a Canadian surfer that's almost drowned in Hawaii, Costa Rica, Barbados. I'm not sure where else I've almost drowned in, but I'll tell you what, I enjoy getting out in the waves. So I really appreciate you offering this opportunity to me, and I believe so strongly in this because I believe I've seen a lot of stuff that would make most people's heads spin in terms of the reality of the current financial system.
Yeah. Now, I know you said that you have recently found Twitter. I want to make sure we're going to link that down below. Is there anywhere else that people should keep up with you? Do you have a newsletter?
I do not. I have this research paper that I've written that Plan B was referring to today. It's linked. I think I sent it to you, but I'll send it to you again.
Yeah, we'll link that.
But it's I think it's important because I put it out there. It's not easy reading, and you can skip through the stuff, but there's a lot of good stuff in there. Well, maybe not good, but it's a couple of little good war stories and everything like that. So
cool. You coming to Miami?
I'm looking forward to getting there. Whether I'm allowed to get there because the border in Ontario is closed or whatever, I might have to ram through it with some
you're in
sort
Ontario.
of. That's where I am. Yeah, that's not a good place to be in the world right now.
I've seen those videos going viral.
I think that it's maybe worse. The bark is worse than the bite, but there's some incompetent politicians, unfortunately.
Hey, the Caribbean's great right now, Greg. Good time to take a vacation. Get out while you can.
I love Barbados. I haven't spent a lot of time in other parts of the world, but Barbados is a beautiful part of the world. So enjoy your time in Puerto Rico, and hopefully I do run into you in Miami. All right.
All right, Greg. Thanks so much.
Thank you again, Mark. Thank you so much for having me.